Hey, what's good? It's your boy Matthew Michael, and in today's video we'll be revisiting the Ghetto Spread. And for those of you who don't know what the Ghetto Spread is, click on this link right here. Go watch that video, then come back to this video immediately. Because in that video there was some things that some people didn't understand. So my goal for this video is to clear all those questions up. So if you're new here, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post 2 new videos every week, and I would absolutely love to have you as part of the family. Also, please be sure to smash the like button. It really helps to grow the family, and I really appreciate it. And you probably already know this, but right now, Webull is giving away 2 free stocks valued up to $1,400 to anyone who signs up and makes a deposit as small as $1 using a referral link. So if you're interested in signing up for Webull and getting 2 free stocks valued up to $1,400, check out my link down below in the description. One last shameless plug before we get into the video. I'm just gonna leave my Instagram right here. Alright, but without further ado, let's get into the video. Alright, so let's get to it. The Ghetto Spread. Okay, so like I said earlier, I'm making this video as a follow-up to the last video I made about ghetto spreads because I didn't explain it as clear as I could. So in order to try to make this a little bit more clear, I'm going to talk about the benefits to a ghetto spread, the drawbacks to a ghetto spread, and just some simple rules and how to set it up. And by the end of this video, you should have a better understanding of how to set up a ghetto spread, its benefits, and its drawbacks. So yeah, let's start with some of the benefits of a ghetto spread. The first benefit to the ghetto spread is it limits your risk, and that means you don't have to worry as heavily about the market changing course as you would a naked call or a naked put. And for those of you who don't know what a naked call or a naked put is, when you buy an option without any way to protect it, it's considered naked. Alright, but moving on, the next benefit to the ghetto spread, as I explained in the last video, is you're gonna be able to get in positions and get your money out all within the same day and not use any day trade. It's a great way to increase your profit potential while still being able to have free cash available to trade. In my opinion, this is like the most awesome strategy ever. I use it all the time and it's really been working for me. Okay, so I boosted the ghetto spread enough. Now it's time to talk about what are the drawbacks of the ghetto spread. The first drawback is, just like it limits your risk, it also limits your potential profit. So with that, your profits are capped. You can't take any more profits than the difference of the spread. So yeah, that's something to keep in mind. If you're greedy, this may not be the strategy for you, but also if you're greedy, this may be the strategy for you because you probably need it, because you probably lose a lot of money. But let's move on. The second drawback to this strategy is it doesn't always work. If you open the position with the intention of setting up a ghetto spread, you don't always get the opportunity to set up a profitable ghetto spread. Now that's only 2 drawbacks, and I think I said 3 benefits. So you see why this has become my go-to strategy. But along with the benefits and drawbacks, there are also some rules that can help ghetto spreads go more smoothly, work out better, and achieve the maximum profit potential. But before we get into those rules, I just want to say one thing right here. The ghetto spread is not some magical trading tool that automatically revives a lost position from the dead. So don't expect that with the ghetto spread. It's simply just going to take a good position and potentially make it even better. So yeah, now that I got that out of the way, let's get to these rules. Just a quick side note, for those of you who want to sound more financially literate, the actual financial term for a ghetto spread is actually called legging in. Now that I've said that though, there are 3 rules that are going to help you make the best of your ghetto spreads. The first rule is do not trade weeklies. And for those of you who are new to options and don't know what weeklies are options that expire within a week. They typically expire on Fridays, so don't try to ghetto spread anything with less than a week on it. Time is your friend with the ghetto spread, and having time on the ghetto spread really works to your favor because you have time on the options and because you don't have to worry as much. So yeah, get time on your options. The next rule when trading a ghetto spread is not really completely a rule, but ghetto spreads are best done when you're up on a contract. That way, whenever you make the ghetto spread, along with your initial investment, you're also taking out some profits with it. And then the third and final rule is when you buy a contract and when you sell a contract, they're going to happen at 2 different times. And because this is a spread, these are 2 different contracts. You're always going to start off by buying one contract. Whatever contract you have, you're going to make sure you have longer than a week on it. Get some time on it to let things happen, let things work out in your favor. And then after you're profitable on that first contract you bought, you then go to a further strike price that is priced above what you paid for that first option, and then you sell it, and then as soon as you sell it, you get your initial investment back, and if it was greater than the price that you bought the first for, you also take profits on it, and you get to stay in the position. I want y'all to listen up right here, because this is something that y'all weren't getting in the last video. There is no risk in selling that contract. When you sell the contract further out than the one you bought, the one that you bought covers the one that you sold, and the profit that you're able to potentially realize is the difference between these two strikes. So really, that's everything you need to know about the ghetto spread, but I know it can be kind of confusing just hearing it, so because of that, we're going to hop in Robinhood and we're going to set up a ghetto spread together. Okay, so we're here in the handy dandy Robinhood, and we're going to set up a ghetto spread on Apple because I actually have an open position right now. As you can see right now, I have an Apple 210 put, and it expires March 27th. And just so you know, today when I'm recording this, it's the 17th, so it's close to being a weekly, but it's not quite a weekly because I have more than a week. But there are a couple things I want y'all to pay attention to as we construct this. So one important thing to note is when constructing a ghetto spread, you gotta pay attention to three things. So this is the first contract I bought, and this is a 210 put that expires March 23rd, and I bought it for $4.25. It's important to know because when I'm selling one, I want to sell a put that is further out the money. I want to sell it out of the money for more than I paid for this option. In order for me to take profits initially, I want it to be for more than I bought this option for. So in order for me to do that, I'm just going to hit trade. I'm going to view all options, and then you can see right here on the top, I'm already on sell and put. That's where I need to be. And if you take a look, you can see right here on the 210 strike for this put, it says it's sitting at 420, and there's a +1 by it. That means I have one of those positions. Now, since this is a put, further out of the money is downwards on the options chain. So in order for me to make a ghetto spread with this, I need to go further out of the money. Since it's a put, I need to go down. So any of these are game for a ghetto spread. But also, with that being said, it's also important to note that I paid $4.25 210 put. So if I get this 205, I don't want to do it for any less than $4.25. But as you can see, it's not there yet, so that's why I'm waiting, and I don't have a ghetto spread on this right now. This could also work for any of the puts this way as well, but yeah, there's none of these that I can do right now. I want to show y'all that you can also set up a limit order, and whenever the market opens, if it opens way down, I can get it filled whenever the market opens. If I could potentially get it filled at market open. I just wanted to show y'all just for the heck of it. I'm going to click on the 405 put. Okay, so you see we're looking at the 405 put, and I just want to let y'all see that it'll let me do this. Okay, so I have one contract because I have one of the other puts, and then I'm going to set my limit price at $4.30. just so I can make $5 profit off this. And then I'm going to hit review, and then I'm going to swipe up. And I want y'all to notice that there were no issues with me doing this because the option was covered. Robinhood, it won't let you make any trades that you don't have the money for. And I was able to make this trade because the other option I bought covers this. But now I'm going to go cancel that because I actually want to squeeze more profit out of that later. That's all you're getting for the example of how to set up a ghetto spread. I feel like I did a decent job of explaining, but I know some of you are also wondering, how much profit can I make off these trades? So because of that, we're going to hop into the calculator real quick and we're going to take a look. And yeah, I want you to be able to do the math for this yourself. So yeah, let's hop in the calculator. Okay, so we're here in the calculator, and I want to show you how to calculate the math of after you take those initial profits and you get your money back. This is how you're going to do the math to see what profit can still be potentially made if you wait until the option expires. So using those two options that we just used for the spread, we're going to use that as an example. Okay, so I had a 210 put and a 205 put. And the way to find the potential profit for the ghetto spread, you simply just take the difference between the options, and that is your potential profit. So the one I bought was 210, and then the difference, and then to get the difference, I'm going to subtract 205, and that gives us $5. And just to remind y'all that $5 on the option chain is actually the equivalent of $500 because it's $5 a share. You always multiply everything by 100. That gives me a max potential profit of $500. I already got my initial investment out, and yeah, that's a free trade that I don't even have to worry about anymore. So yeah, this is most definitely a powerful tool, especially in times of volatility like this. So please let me know, did you understand that? Let me know down below in the comments. If you enjoyed the video or if you learned anything from the video, please be sure to smash the like button. And if for some reason you're new here and you still haven't subscribed, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post 2 new videos every week, and I would absolutely love to have you as part of the family. But that's going to be it for today. Thank you so much for watching, and peace.